Greetings all, and welcome to the Sibanye-Stillwater presentation that we've prepared for the BMO Conference. It's titled Well Positioned for Ongoing Value Creation. Thank you for taking time out. I'm sure you're going to find this interesting, informative, and hopefully stimulating. As always, please take note of our safe harbor statement. I would urge you to read that in your own time. Moving on to slide number 3, and I'd like to start on the right-hand side of this slide, which really outlines where our assets are located. Starting at the top of the page, we have a number of producing assets in North America and a number of projects in Canada. Stillwater is obviously a tier 1 operation consisting of the Stillwater mine and the East Boulder mine. Long life, high quality primary palladium producer. We've just acquired a 30% stake in the Calibre project, our first step into battery metals, and certainly I will talk about that a bit later in the presentation. Moving on down to Southern Africa, the majority of our assets are in South Africa. We have a number of PGM and gold projects there. I'm not going to go through them one by one. Moving to the left-hand side of the slide, important to note that we have significant reserves of gold and PGMs. It's also important to note that it's only 17% of our resource base. So we're a long life company, both in the gold segment and in the PGM segment. If you look at the split in production, which is the center pie chart, you can see the split between gold, the US PGM operations being 19%, and our South African PGM operations making up 48%. If you look at the contribution from an earnings perspective, you can see gold is relatively small, 16%. We would like to make it larger. I'll talk about that later on in the presentation. Our US segment generates about 26%. Important to note that that should grow as the Blitz project ramps up. And then, of course, the bulk of our earnings are coming from our South African PGM portfolio. Moving on to slide number 4, important to note the earnings history there as well. And we show it from 2016, where we were predominantly a gold company, and the bulk of our earnings, in fact, you can see it there, 99% came from gold. And you can see how we've transitioned over a period of time with in H2 2019, notably becoming predominantly earnings from PGMs. You can also see how we took on debt to acquire the Stillwater assets. You can see from the red dotted line how our net debt to EBITDA went from 0.4 all the way up to 2.6. And very pleasingly, you can see how, as the PGM assets that we acquired have come on stream, how we've actually gone into a net cash position. Importantly to note on that graph, the H2 2020 earnings, gold has stabilized at previous levels post-COVID and some other issues in 2018 and 19. South African PGMs again contributed the majority of our earnings, 60%, and pleasingly, despite the very significant impact of COVID in the US, our US PGM operations delivered 21% of our earnings. So from the graph, you can see these are record financial performances from our enlarged South African PGM base. As I said, gold production has normalized. US production was consistent despite the COVID-19 impact. We clearly benefited from the higher precious metals prices that we predicted, and hence our entry into the PGM sector. We had a record 1.2 billion US dollars of free cash flow. We had EBITDA of 3 billion US dollars. That was an increase of 190%. Deleveraging was achieved, as I've said, and very pleasingly, we declared a 720 million US dollar dividend for 2020. That was at the high end of our dividend policy, 35% of normalized earnings. The final dividend was at a 7.8% dividend yield, putting us back on the map as an industry-leading dividend payer, something we're very pleased about. So hopefully now that I've got your attention, you will want to really understand how all this was possible. Obviously, if you know the PGM market, you would know that we're entering a super cycle. I will come back to that shortly. Most of the questions we get at the moment are not about deleveraging, as we've deleveraged, but it's more about capital allocation. And slide number 5 actually shows you the priorities in terms of capital allocation. This is the board-approved capital allocation model. The focus is on the first priority, project capital, to create value and sustainability for the company. And I will talk through 2 significant value accretive projects that we've just announced. We do want to build up our cash reserves predominantly to offset debt, which we want to keep on our balance sheet, and of course, have cash on hand for opportunistic uses. Our dividends will be predictable, consistent, and significant. If we embark on any M&A, it will not disrupt the industry-leading dividend payment. Of course, debt management is something that we will focus on. Share buybacks are an important part of capital allocation. And in fact, we've actually moved to a cash-settled long-term incentive scheme, which is our first real buyback program. So that is the model we will be working to, and it's found a lot of support and favor with our shareholders. Moving on to slide number 6, as I said, you would want to understand how all this happened. If you look at this graph, it's an indication of the commodity prices and the points in time that we entered the PGM market and in fact made the DRD gold acquisition. You can see these were at a low point in the commodity cycle, and of course those entries have created very significant value for our shareholder. You can see how the commodity prices have increased as we move to the right of that graph. Moving on to slide number 7, something we're very proud of, and we were listed in February 2013, and we have outperformed all our peers in the industry over this period, and I dare say we will continue to outperform them. The yellow and the black lines is really our JSE and ADR listing, and you can see the significant outperformance to our peers. Moving on to slide number 8, and this is one of the reasons that I suggest we will continue to outperform our peers. We have the combination of gold and PGMs. And earlier in the presentation, I said the PGMs are moving into a super cycle. The 3 key PGMs, platinum, palladium, and rhodium, have really good fundamentals that underpin them. I'm not going to go through it in detail, but the demand for platinum will increase, predominantly initially through substitution of palladium in gasoline autocats. That will bring the palladium market into balance, but platinum will move into a deficit from 2024. And of course, the longer term potential demand from the green economy, the hydrogen economy, really underpins platinum well into the future. So platinum has a really good fundamental long-term future. With respect to palladium, the deficit will widen again in 2021. There will be some substitution of palladium by design. We have sponsored research to get palladium back into balance. And we believe that should there be any excess palladium, or should palladium move into a surplus, that will be a great opportunity to address the very significant deficits that are occurring in the rhodium market. As you can see from the rhodium block, rhodium is really an autos metal. 90% of its demand is based on autocats, and with the very significantly increasing environmental requirements, rhodium is in a deficit, will continue to be in a substantial deficit, and you can see why we are at significant all-time highs in rhodium. Many of you would have known that in the early 2000s, both rhodium and palladium went through a peak and then a real demand destruction phase. And you might say, well, we're heading there again. We're not heading there again. In the early 2000s, there was significant flexibility from an environmental point of view for end users to change their mixes at will. That flexibility doesn't exist today. The environmental regulatory environment is much more rigid than it was then. As producers, we don't want to see unstable conditions, and we are working with end users to ensure that the combination of these PGMs is sustainable. Moving on to the next slide, and the next section of this presentation, there's a couple of strategic areas that I'd like to cover. Our strategic focus areas are indicated in the diagram on the left-hand side. The core of our strategic focus is embedding ESG excellence in the way we do business. That really encapsulates everything around that circle. We have initiatives and executives responsible for each one of these areas. Building a values-based culture is certainly a focus area, important for safety. I'm not going to talk about that today. Focusing on safe production and operational excellence, I think you've seen some of that already. I do want to talk about projects though. Optimizing capital allocation, I've already discussed. Prospering in South Africa's investment climate. I have discussed how well our South African PGM and gold business is doing. I think that's testament to that strategic focus area. Pursuing value accretive growth based on a strengthened equity rating is certainly an area I'd like to cover in this presentation, and we'll do that towards the end. A couple of ESG issues are incorporated in the next few slides. And underpinning that is our ethos. And I think it's important for any investor to understand the way we do business, the way we think about business. Our purpose is, we believe our mining improves lives. We believe in superior value creation for all stakeholders through the responsible mining of our mineral resources. And in fact, our strategic intent is to strengthen our position as a leading international precious metals group by doing the things that are listed on the slide. Perhaps best displayed in terms of our ethos is our Sibanye-Stillwater tree. And that tree is something that every one of our employees understands and can relate to. And I'm sure when I explain it to you, you'll find it quite intriguing. We talk about Sibanye-Stillwater CARES, and CARES is an acronym for commitment, accountability, respect, enabling, and safety. And those are our core values. They're embedded in the roots of the tree. The people of the tree are the trunk of the tree. They give the tree direction. And of course, if the tree is not fertile and profitable, and that means you need to focus on safety, health, and wellness, costs, quality, and volume to produce profits. If you don't do that, you won't have a healthy canopy. And the canopy of the tree provides protection and includes all the stakeholders and the specific areas of focus. So we think about the environment in that canopy, shareholders, communities, organized labor, employees, and so on. I'm not going to go through the entire list. And then, of course, if this tree is really healthy, it bears fruit. And the fruit is things like clean air and water, total returns for shareholders, upliftment for our communities, membership for organized labor, and so on. And we use this tree to make some very material decisions, especially when it involves stakeholders. We share this with stakeholders when stakeholders try to abuse another stakeholder or try to abuse the company for a very selfish reason. We explain the tree, and this tree has served us very, very well. Moving on to slide 11. And as I said, I wanted to talk about a couple of ESG related issues. The metals we produce are making a difference to the environment. And of course, they are profitable and allow us to share value with all our stakeholders. Those metals are predominantly now used in autocats. They clean the air, and they certainly make the environment better for all of us. As we look towards the future, something very important, the hydrogen economy is going to be very disruptive technology in a good way. It's going to further enhance the environment, and clearly we want some exposure to that improving environment and of course the technology. Again, I'd urge you to read the slide in details, but the metals that are required and are gonna underpin the future hydrogen economy are platinum, iridium, and ruthenium. We are the biggest producers, while I'm on this chart, of iridium and ruthenium in the world. We're also the biggest producers of rhodium and platinum. So we have very significant exposure to the future hydrogen economy. And of course, that's going to be very beneficial to all our stakeholders. Moving on to slide 12, we announced with our year-end results that we are targeting carbon neutrality by 2040. You can see some of the work we've done to make that commitment. Internally, we've got earlier targets, and hopefully we can, as we develop our mechanisms to achieve this, we can get to an earlier carbon neutrality target. And when we are confident we can achieve that, we'll certainly share it with the market. Our goal is underpinned by our energy and decarbonization strategy. We are energy intensive, and of course, most of our energy at the moment is produced through coal-fired power stations. That's clearly not sustainable or appropriate, and we are advocating through various organizations to have this changed in South Africa. We've built these decarbonization targets into our long-term long-term incentive framework. You will be able to read that in our annual report, which will come out in a few months' time. We're constantly improving energy efficiency. Over many years, we target 2 to 3% per year-on-year improvements. And we estimate that we've saved 165,000 tons of carbon emissions by this initiative in its own right. We are well advanced with a 50 megawatt solar PV plant for the West Wits in South Africa. We are looking at 200 megawatts of additional solar PV storage and wind projects for our PGM operations, specifically in the Rustenburg area in South Africa. And we are targeting 20% renewable penetration by 2020. So there are well-developed plans that underpin these carbon neutrality targets. As I said, I wanted to talk about two projects. I mentioned this with the capital allocation model. We have just announced the K4 project. It's an unrivaled tier 1 PGM project, and when I run through this, I think you'll see why. It has relatively small project capex, and we quoted here in rand terms, 3.9 billion rand, which will be spent over 8 years, the majority in the first 3 years. At steady state, this mine will produce 250,000 4E ounces per annum, almost over 50 years. That's quite incredible, 50 years. The average operating cost is 16,000 rand a 4E ounce. The current basket price at this for this particular operation is around 50,000 rand a 4E ounce, so very significant margins. It'll produce a total of 11.5 million 4E ounces, and you can see with that margin, it's got a 6-year payback at the budgeted prices, but 4 years at spot. The NPV, and I'm only going to quote the numbers at spot, is 21 billion rand for a 3.9 billion rand investment. I dare say that's value accretive to our shareholders. And the IRR at spot is 80%. And again, there's not many mining projects that will return an IRR like that. So this is a wonderful project, and you might be saying it's too good to be true. Well, let me show you why it's not too good to be true. This is a project, and it'll mine, let's get through the technicalities, both Morensky and UG2, down to a depth of 1,287 meters. That's shallow mining by South African standards. The key issues why this project is such a good investment is that the previous owners sunk 4.4 billion rand before they ran into financial difficulties. So the bulk of the capital was spent by another owner. They built concentrators, they sunk and they equipped the shafts. There's existing surface infrastructure, and of course they did much of the on-reef developments. Very pleasingly, a project like this has very significant regional and social and economic benefits. It certainly ensures sustainability of the Marikana operations for over 50 years. We've turned this entire region to profit and therefore sustainability. It's a significant investment in the local economy. It'll provide 4,380 jobs at steady state, meaningful opportunities for local procurement, and of course skills transfer. So we are very, very pleased with this project, and I think you can see from these numbers the very substantial value accretion that it brings to our shareholders. The other project that we announced we will be continuing with is Bernstein. Bernstein has a project capex of 2.3 billion over 14 years. We acquired this project for R1 from the previous owners. It was a project that did not work. We believe that there was very substantial misunderstandings of the geological model. We've improved the modeling. We have a proper sedimentological model. Myself and my team know how to mine Kimberley reefs. They are very channelized, and certainly we believe we'll bring this successfully to account. The average steady state production is 138,000 ounces per annum, just under 140,000 ounces per annum. The operating cost, 415,000 Rand per kilogram. Current gold price, about 800,000 Rand per kilogram. So very significant margins as well. 2 million ounces will be produced over a 21-year period. Again, significantly long life. Net present value, 3.8 billion at spot, an IRR of 39% at spot. Again, common language is IRRs, where you don't have exchange rates and you don't have to work out Rand to dollars and so on. A 39% IRR is blooming good in anybody's language. It's got a 7-year payback and 6 years at spot. So again, a great opportunity for our shareholders from a value accretion point of view. As I said, we acquired this from Wits Gold in 2015 for literally R1. It is a shallow mine, average depth 550 meters below surface. That is shallow. A lot of existing infrastructure spent and put in place by the previous owners. A metallurgical facility, a tailage storage facility. We've got functional vertical shafts and declines. We've got infrastructure such as offices and workshops and so on. And we have extensive underground development, which is absolutely necessary in understanding and preparing for mining of a channelized ore body like this. Again, very pleasingly, very substantial regional, social, and economic benefits. The Balfour community is an impoverished community and has very significant unemployment. So this will make a difference in that area. It'll create 2,500 long-term jobs and, of course, meaningful opportunities for other participation. So very pleased. And these are good examples of the type of project capital in terms of our capital allocation model that we will consider. I'd like to move on now to slide 17, where we talk about growth through an increasing equity valuation. So our value accretive journey has been discussed very simply earlier on in this presentation. We use sigmoid curves to indicate the various stages of our growth. The company was built off a gold base. You can see that was number one. We turned what were non-core assets and assets that were not working very well into significantly cash generative assets. We then went into the PGM sector, initially just in South Africa, which is represented by line or sigmoid curve 2. We then went into internationally into the US and acquired Stillwater, which was really the first step of internationalizing the company. If you look at the fourth sigmoid curve, which I've just brought up onto the screen now, you would see our vision of becoming involved with battery metals. or the high-tech metals. And this is again driven by two things. The one is our need to remain exposed to green metals, but also because we fully understand the end users. They're the same end users that use PGMs, and predominantly the metals in that sector that are of interest to us are lithium, nickel, and cobalt. Now, like we did when we went into PGMs, we spent 2 years understanding the supply and demand and identifying targets and strategies. We've done exactly the same in battery metals, and I'm very pleased that we made our first move literally a few days ago, and I'm going to discuss that in the next slide. So that is pretty well known. I think what we can already start seeing, and I've just brought up the hydrogen economy exposure that we expect as our fifth sigmoid curve. So that is how we think about the company. Now, there is one aspect I would like to raise. The fourth and the fifth sigmoid curve are new areas, although the fifth sigmoid curve would really be metals that we produce as we exist today. What you would have seen from some of the numbers that I've presented is that the value of the earnings potential, I should say, of our gold business has become relatively small. We do like gold, we believe in gold, and we believe that the counter-cyclical nature of gold and PGMs is important in terms of creating stability and ensuring that we have a sustainable dividend flow. And we would like to still grow our gold business, and that is an area that's receiving attention. As I said, moving on to slide 18, I'm very pleased with the small but very significant step in the acquisition of a 30% stake in the Calibre lithium hydroxide project for 30 million euro, which we have the right to increase to plus 50% after an advanced definitive feasibility study. It's ideal geography. Finland is a top 5 mining destination, according to the Fraser Institute. The Finnish government, through FMG, is managing or is a shareholder in this business, and they have chosen to partner with us and us with them. I think that is very significant from a battery metals point of view, and I will tell you about that now. Of course, it's a low environment footprint, and we look forward to making this an ESG showcase together with FMG. It's an advanced project, 13 years of life with the opportunity to extend. First production is in 2024 with 15,000 tons annual run rate. Importantly though, and we have been saying that our entry into the battery metals is going to involve partners, and you can see our partner here is FMG. It is going to involve supply chain considerations, and as you can see from the last bullet point, this is a fully integrated lithium producer in Europe, with direct access to the market from the port of Kokkola into the heart of Europe. And Europe is a key destination for battery metals. So this project, together with our partners, has all the right attributes that we have been looking for in terms of our entry into battery metals. So let me conclude with slide 19. And we have seen significant re-rating in our share price, but I'm very pleased to say If you found this interesting, it's not too late to buy our shares. We are still significantly undervalued, as you can see from the following analysis. And of course, there's many ways to look at valuations, but if you look at enterprise value per EBITDA for 2021 and 2022, you can see our multiples are well below the rest in the industry. So we will continue re-rating. If you look at price on a cash flow per share basis, it shows exactly the same thing. And essentially what's happening is the commodity prices and our earnings are going up faster than our share price is going up, even though there's been very significant re-rating in our share price. Hence, we are still cheap. Our net debt to EBITDA, as you can see, has actually moved into a negative position compared to our peers. We are net cash. And if you look at some of the previous slides I presented at BMO, as I say, you will see we've moved from the bottom of the enterprise value and market cap table. We've at least moved up above the intermediate gold. So as I say, we have re-rated and we'll continue to re-rate, but our earnings and cash flow per share are increasing at a larger rate than our re-rating. So there's still opportunity to get into what is essentially an undervalued stock. So with that, it brings me to the end of the presentation. I'd like to again thank you for your time. I hope you found that informative, interesting, and we look forward to presenting to you next year at the BMO conference, and hopefully we can continue to demonstrate very similar outperformance. Thank you very much.